Well, this is basically I am studying for my SBR examination in December. I'm used to teaching someone with me, or I speak while I study. So I am trying to put it to good use, and I'm going to be uploading these lectures to YouTube. If this helps anybody in studying or understanding anything related to SBR, and I'll be also covering AFM. Good for you guys. And if it doesn't, I think mostly it won't, because there are way more qualified people teaching these subjects online. However, the reason I'm doing this is maybe it will help me only revise in the future. So the first chapter in SBR frameworks, quite simple. Frameworks are nothing. The conceptual framework is nothing but a layout or a basic blueprint for financial reporting. It has two major components to it. So, conceptual framework for financial reporting is used by the board when developing or revising an IFRS or IAS standard. The preparers of the financial statements when no relevant IFRS or IAS standard exists for a problem. And secondly, the second component of conceptual framework is that it is it involves fair value measurement, and all the elements which are part of our financial reports are can be basically measured using the fair value measurement, and the conceptual framework lays out a blueprint for the same. The importance of conceptual framework is mainly towards investors and shareholders. We'll get to how it is relevant to these people. First, the background is not very necessary in terms of examinations. But still, we can say ki the framework for presentation and preparation of financial statements was made in 1989. But then by 2004, the board, the International Accounting Standards Board, and the US Financial Accounting Standards Board, they both got together and realized that this is very outdated, and they wanted to make a new framework on the basis of which we would prepare financial statements henceforth. However, they started a project in 2004, and by 2010 they released a draft of it, called the Conceptual Framework for Financial Reporting. It was very highly criticized due to the fact that it did not cover certain areas such as derecognition, presentation, and disclosure. The guidance in some areas was very unclear concerning measurement uncertainty, and some aspects were out of date. For aspects like recognition criteria for assets and liabilities was out of date, due to which the board then again started this project of the conceptual framework in 2012, and then in 2013 they released a discussion paper outlining their thought process and comparing it with, maybe they were asking for advice in return. We are not certain about that here, but then in 2015 the proposed amendments of the exposure draft was published, and feedback again was taken on it, and by 2018 we had the conceptual framework. So the purpose of the conceptual framework is, again, it, it helps the board in creating and revising new IFRS standards. It helps the preparers of financial statements when there is no particular IFRS standard or IS standard relevant to the concern, to their concern, or the problem they are facing. And it also helps all parties when understanding and interpreting the IFRS standards. So, conceptual framework is not an accounting standard. It is it does not override the requirements in particular IFRS standards, but conceptual framework is just a blueprint or just a roadmap to how financial reporting is to be done, read, and analyzed. So the objective of financial reporting is towards the investors, lenders, and creditors. It is that they can assess financial reports and they can help understand the future cash flows of the entity as well as the management stewardship of the entity's economic resources. So we all know what entities potential future cash flows looks like and what the basic deal about it is. However, management's stewardship of entity resources means how well the management of a particular organization is using the entity's economic resources. And by economic resources, we here we mean the entities. I'm sorry about that. However, so where were we? The management stewardship of the entity's economic resources, right? So basically, we see how well the management manages or utilizes the economic resources of the company, which may include equity, it may include liabilities, and it may include assets. So it includes every type of economic resource the company has and how well the management is using them, is there optimum utilization of them or not. So that is one thing that is showcased in financial reports. And then the summary of the content of the conceptual framework. So basically conceptual frameworks are consisting of financial statements. Sorry, what am I speaking? I'm really sorry. Financial statements are consisting of elements and presentation and disclosure and qualitative characteristics, which at the end of the day gives us useful information. This useful information or financial information that is interpreted through financial statements is later used by investors, lenders, creditors, stakeholders in general to assess whether it is good to deal with the company or not. The financial statements elements which we're talking about, the conceptual framework helps in understanding the definitions of these elements, how to firstly define a particular element, and how to note if a particular expense is a part of a particular element or not, or how to justify whether a particular expense has been done for an of creation of an asset or not, what is an asset, what is classified as an asset. Everything is laid down in the definitions, and the conceptual framework provides a basis for that or includes these definitions per se. The measurement of these particular elements is, we can understand whether how much an asset is costing, the duration, net present value, everything is done through measurement. And again, the conceptual framework lays down a base for that. Whether we should recognize or de-recognize a particular expense, or how should we recognize a particular expense, if we have wrongly recognized a particular expense, how to de-recognize the same, or I'm saying the word expense or I'm saying asset, but it's not limited to that. It's applicable everywhere. So that is also notified within the conceptual framework. Presentation and disclosure. Now we come to the second part of the content in financial statements. And firstly, we see aggregation. What is aggregation? two things: segregation and aggregation. Segregation is distribution of a set of objects. For example, if I was to draw a circle here, can I? No, I can't. Um, can I just draw? Yeah. If this is a circle, I'm sorry if my drawings are not good, but if I was to segregate it, I would divide it into multiple parts which I feel belong together. So if I feel this particular area is inclusive of all marketing, this is finance, this is accounting, this is tech, this is HR. So I was to divide it into different batches or parts, it would be segregation, right? However, aggregation refers to putting different elements of the financial statements together on a particular list, which we can say the reports are, and aggregating them into a single report to understand the financial performance of a company. So, for example, if I was to say that all assets, all equity, and all liabilities, these were to come together. Sorry, I know I should have said assets for here, but yeah, still. So, um, equity and liabilities. So, if I was to aggregate them on a single piece of paper, that would make the balance sheet. Or if I was to, you know, aggregate all our expenses, I'm really sorry about this. Yeah. If I was to aggregate all of our expenses and our incomes together, we would make the income statement. We would make the other comprehensive income statement if I was to aggregate all the information I have of uh, activities that were not directly involved in production or directly involved in the business of the company, but still made us money. And I was to put that in the OCI. That is aggregation. Classification again. Now to present all information together, we have to aggregate that. But at the same time, while presenting to our stakeholders, it should be clear that the information is it is accurate, it is relevant, and it is at the same time it is easy to understand. Usually, classification is done for ease of understanding in terms of financial statements. I'm just talking in terms of that. So, if assets are classified as assets together, because it helps the audience of the particular financial report understand, okay, so these are the assets, we know the definition of assets, we know what assets are, but what are the company's particular assets? Oh, okay, so this is the list of assets. Oh, okay, so this is this, this is this, this is this, this is this, and then they can easily understand, okay, so this is the financial position in terms of his assets. Then we go to liabilities again. So these classifications are very important for the audience of the financial reports to understand and interpret them in a very useful way. The other comprehensive income, OCI, again, it talks about the incomes or the losses that are not directly relevant to the business we do. If I am a manufacturing company and I have pieces of land on which I plan in the future maybe to build factories on for manufacturing a particular good. And the valuation of those particular lands was to increase. That is when I would include it in OCI, in my OCI, other comprehensive income. Not necessarily that I'm receiving cash flows for that particular income though. But yeah, still it is in the mind of an accountant. If you think about it from the mind of an accountant, it is a momentary gain. It is a gain to the company. Okay, so I have an asset that which value has risen, even though I don't plan to sell it right now. But if in the future I do, I should realize that, oh, okay, I'm going to make a profit on that. Then we go towards the qualitative characteristics of usual financial information. What are the qualitative characteristics of useful financial information? It should be relevant, it should have faithful representation, and enhancing characteristics would be comparability, timeliness, verifiability, and understandability. So basically, all financial information is only useful when, firstly, it should be relevant. Relevant information is the only way I could make the information useful to me. If I was to be bombarded with thousands of data, thousands of GBs of data, and and my manager was to say that, okay, so this is information about the product, the market, and everything, the country, the state where the market I'm building is, everything. But my work is only to understand where my product stands in the market. At that time, the only relevant data to me would be data about my product, my pricing, and the market data. Whether do I have any competitors, whether there's a market in general, or should I do market development? What is my standing in the market? What is my market share? Is there a option or a opportunity for growth in the market, or for the market itself to grow? That would be relevant information. Faithful representation. I think, and I'm not meaning to go off topic here, but we as a generation tend to stay in delusion, and faithful representation is the closest opposite of the delusions we are used to as a generation. So, faithful representation is just showing the true nature of information. Faithful representation would show the economic form or substance rather than the legal form or the metaphysical form of the transaction or whatever the information is. So, faithful representation would be complete, it would be neutral, and it would be free from error. We say neutral because companies, organizations could tend to have biased information or hopeful information. For example, if they would want to value their assets at a higher amount, or they would want to value their liabilities at a lower amount, because that's how things would be perfect, right? However, faithful representation lays down that, all right, you don't need to lie to your stakeholders. Just show them complete, neutral, and free from error information and let them decide. So the board notes that this is not fully achievable, but these should be maximized. When preparing financial reports, Preparers should exercise prudence. Prudence means that assets and incomes are not overstated, and liabilities and expenses should not be understated. However, this does not mean that assets and income should be purposefully understated, or liabilities and expenses should be purposefully overstated. Enhancing characteristics of information would be comparability. It should, I won't say it should because these are enhancing characteristics, but it would be great, or it would be for the best if the information was provided in a comparable way where we could compare it to last year or with competitors or with whatsoever nature we want to. It was timely in nature, it was verifiable, and it was true. That is very important. So, faithful representation has complete, free from error, and neutral, right? Verifiability is in accordance to that. So, if these three are matched, then automatically the information should be verifiable so that okay we can be assured that okay so faithful representation is evolved here. Understandability, the information should be understandable and as concise as possible. There should not be tons of data. Again, relevance. Producing financial reports takes time and costs money. uh, this cost constraint. However, did not change the economy. I don't think this is very relevant. Financial statements. The purpose of financial statements is to provide information to users about an entity's assets, liabilities, equity, income, and expenses. The information is provided in the statement of financial position, the statement of financial performance, and other statements such as statements of cash flows and notes. The uh, All financial statements are prepared on the assumption that the current entity is in going concern. So these are all things that all of us must have learned very early on if we're already pursuing SBR. These are all things that we all must know. Reporting entities. Um, mhm. This is also, I don't think there's anything very relevant up here. The elements of financial statements, financial position, financial performance, and then changes in equity and all that. I don't think we're showcasing it here, but later we'll get to know about that. Um, Again, this table, I think all of us would understand it with relative ease. So, in case you don't, or if you don't remember anything, just go through it once. Recognition and derecognition. So, items are only recognized in financial statements if they meet the definition of one of the elements, right? However, the elements are recognized if recognition provides users with useful information. In other words, recognition must provide relevant information and a faithful representation of the asset or liability and resulting income, expenses, or equity movements. A recognition of an judgment. There's a lot of things that are written in our books, which again is not relevant information. I think this could have ended here, but again, they just chose to write three more paragraphs which do not necessarily showcase anything important. Derecognition. Derecognition is the removal of some or all of the asset or liability from the statement of financial position. Derecognition is only done when company loses the control of an asset or I'm sorry, or it has no present obligation for the liability. When these two conditions are met, then the asset or liability is derecognized. Accounting for derecognition should faithfully represent the changes in an entity's net assets as well as any assets or liabilities retained. All right. Measurement and recognized elements must be quantified in monetary terms. Historic value, current value. So, measurement of elements can be done in two broad measurement bases: historical cost and the current value. So, current value includes fair value, value in use, I'm sorry, and current cost. Selecting a measurement base. The information provided to users by the measurement base must be useful. In other words, it must be relevant and offer faithful representation. The characteristics of contribute future cash flows. So basically, measurement must be done on basis of the characteristics of the asset or liability, or the ways in which the asset or liability contribute to future cash flows. Presentation and disclosure. Effective presentation and disclosure. Entity specific information is more useful than standardized description, and duplication makes financial information less understandable. These are two important aspects. Classification of an asset or liability into separate components provide relevant information if components have different characteristics. Aggregation, we talked about. Profit or loss and other income. We talked about this. Criticisms. The criticisms of financial reporting include historical information. So basically, the argument is that investors are more inclined towards getting to know the future of the company rather than historic information. But at the same time, if what relevance or what trust factor would the future, if I was to provide publish future reports that okay in the next 5 years my company would be doing revenue of this, if I do not provide backing data of historical information that okay, so I've grown at the pace of 10% per annum, and in the next 5 years I'll be standing there. Only then will the investor believe, all right, maybe he's right, maybe it is doable, achievable. Unrecognized assets and liabilities. So there are some assets and liabilities that are not recognized in financial statements, such as internally generated goodwill. And that is a criticism. Clutter. They have been criticized in recent years for becoming increasingly cluttered due to extensive disclosure requirements. Financial and non-financial information. Long-term success is yeah, I mean, these are all points which are valid estimates, professional judgment, use of historical cost policy. But I think if we all have reached at this level, we will know by just reading the heading, okay, what this particular point will be saying. So let's not waste our time. Materiality. The concept of materiality is widely used in, however, the board accepts that not to apply materiality. Okay, so information is material if omitting, misstating, or obscuring it would influence the economic decisions of financial statement users. Again, we're talking about the relevance of the information. How relevant is the information? If the information is so relevant that omitting it, misstating it, or obscuring it would influence the economic decisions of the financial statement users, then it should be included in the financial reporting when assessing whether an entity should consider. So, when assessing whether information is material, an entity should consider the quantitative factors measures of revenue, profit, asset, and cash flows, and qualitative factors such as related party transactions, unusual transaction geography, and wider economic uncertainty. Recognition and measurement. An entity only needs to apply the recognition and measurement criteria in an IFRS standard when the effects are material. Presentation and disclosure when organizing information material matter. I don't think all of this is necessary or to read. We all understand this at this level. If you do not, I would suggest that you go through it once. But I'm pretty sure everybody who's reached SBR level would know what's written here. Um, IFRS 13 is fair value measurement, and many accounting standards require or allow items to be measured at fair value. So IAS 16 PPE allows entities to measure PPE at fair value, and IFRS 3 business combinations classifies the net assets of a subsidiary to be measured at fair value at the acquisition date. So IFRS 13 does not apply to share-based payment transaction and leases. What is the definition of fair value? Fair value is the price that would be received to sell an asset or paid to transfer a liability in orderly transaction between market participants at the measurement date. So, when pricing an asset or a liability, market participants would take into account the condition, location, and restrictions on use. And there are various approaches determining the fair value of a market, sorry, of an asset or liability. So market approaches valuations based on recent sale prices, cost approaches valuation based on replacement cost, and income approaches valuations based on financial forecast. An active market, what is the price that would be offered in an active market for a particular asset is known as its fair value in market based measurements. What is the active market? Um, an active market is a place where the asset is ready to be purchased by the buyers and the seller is ready to sell it. Ready to sell it. Um, the pricing at which the seller is ready to sell is actually the pricing at which a buyer would want to buy a particular good. An active market is basically any market where there is a demand and supply for an asset or liability. IFRS 13 classifies inputs into valuation techniques at three levels. Inputs are quoted prices for identical assets in active markets, observable prices that are not level 1 inputs. Level 2 inputs may include quoted prices for similar assets in active markets, quoted prices for identical assets in less active market, and observable inputs that are not prices. Level 3 inputs are unobservable. Unobservable inputs could include cash or profit forecasts using an entity's own data. Let me see how long is this. My God. Okay. So lots of tons of information that is not necessary for us to understand. I think we were done with this. So markets, the price received when an asset is sold um, may differ depending on specific market and where the transaction occurs. What is principal market? Principal market is a market where the greatest activity for the asset or liability is being measured. So principal market is the primary market, basically you could say, where it is very general for an asset of the same nature to be sold or liability of the same nature to be sold. Most advantageous market, there's no principal market, then fair value is measured by reference to prices in the most advantageous market. Maximizes the net amount received for selling as an asset. All right. and I don't think this is important in any way. So let's just skip it. Non-financial, yeah, again, non-financial assets and all this thing. So this is the end of frameworks. I hope you guys like this video, and I'll be trying to better the quality and better how well I explain particular points, because at the end of the day it's going to help me only to revise for SBR. And if anybody views it and finds its use or finds this useful, great, I'm grateful to you. Great. And please continue. Thank you.